So Brickell Analytics is a two-part research service. We have a systematic approach to markets and we have a global macro approach to markets. Both approaches use 4 different types of tools. Our time model, our velocity model, our price model, and our sentiment model. Right now, we'll go into each tool and then we'll explain our forecasting via our 2 different types of strategies. So what is wave theory? Wave theory is basically a theory that is used to forecast markets based on fear and greed. You count waves in charts and you make predictions. When markets are high, you predict tops. When markets are low, you predict bottoms. And we use the prediction model. We use about 73 rules to make predictions. We have a tool called the Brickell Speedometer indicator. It's very useful at very critical turning points. When markets are very high, we can measure the speed of markets and tell whether markets are slowing. And if they are, they're very close to a top. And it's very, very useful at market bottoms when markets are very low and markets have crashed. It gives us a signal and lets us know that markets are very close to bottoming. And it was very useful in March of last year to help us forecast the bottom. The sentiment indicator is also a contrarian tool that we use to call market tops and market bottoms. That is very useful as well. So we've used the tools to put it into 2 different models. We have a quantitative model on oil that generates long and short signals, and the model has been very predictive of the oil markets, whereby it's generated about 540% return since 2012. The model has been very useful also in predicting the direction of the S&P, and it's been generated about 130% return since 2011. So that's our tools and our systematic approach to markets. But the most important thing now is to get to our discretionary strategy, which was very helpful in helping us call the market bottom last year. And it's going to be very helpful in allowing us to call the market top this year, which we think is very close to approaching. So last year, using the Elliott wave rules and theories and price targets, we were able to see a top in the S&P 500 forming at about 3,400. And then we called for a reversal in the market to 2,350. The market crashed during COVID, and then right around mid-March, when the S&P was about 2,200, our wave forecasting was allowing us to see that the market was going to rally. So we had a downside target of not more than 2,000 on the S&P, but the S&P had to rally above 3,500, which was the prior high in February. So as you know, the S&P is above 3,500. Same forecast on the Russell. We thought the Russell was very, very oversold, and it was due for an 80% bounce. When the Russell was at about 1,000, we said, look, the Russell has to rally to about 1,800. And as you know, the Russell right now is way above 1,800. We had a bullish forecast on the banks, especially JP Morgan. JP Morgan was trading at about $100 a share. We thought JP Morgan would rally to about $120 a share. This was right around the election time or a little bit before the election. JP Morgan is, as you know, above 120. It's closer to 160. Same forecast on Boeing. We were very bullish on Boeing when the stock was at about 144. And as you know, last week, the airlines and Boeing surged, and Boeing got to $270 last week. So this forecast also materialized. We were very bullish on Disney. We thought Disney could reach its prior high. And so we called for a rally to 155. Again, Disney is above 155. So that forecast also worked out. We were very bullish oil companies. We zeroed in on an energy stock called Occidental Petroleum. The stock was trading at about $8 a share. We thought it would go to $25 a share. And Occidental right now is closer to $30 a share. And lastly, in November of last year, we thought Apple would revisit its September high and rally to $150 a share. The high in September was 138, and Apple ended up rallying to about 145. So we made 8 forecasts last year, 1 bearish forecast at the top, and then 7 bullish forecasts at the bottom. So our bearish forecast last year panned out, and then our bullish forecast materialized. And the question is, what's going to happen now? So we're zeroing in on the S&P 500, and the pattern has been forming since the low of last year in March at 2,200. Since last year's low at 2,200, the S&P has been forming what we call a terminal pattern. It's an ending diagonal pattern. The ending diagonal pattern is a pattern that forms the geometric shape of a triangle. And so the market starts rallying very sharply. As you can see in this chart, the market rallies very sharply. So the first rally off of the March lows into about June of last year was a very big rally. Then the market went down a little bit, then it went up, and then it went down into October and November. And then since November or the elections, the rally has been narrowing in the S&P 500. This type of pattern allows us to create what's called a triangle by drawing 2 converging lines. So you have a very wide base, and then you have a very narrow point or end, which is the triangle pattern that is concluding right now, as you can see through the chart, where you have these 2 lines that are narrowing, and then they kind of run out of room. So this converging pattern, or this ending diagonal pattern, is what's called the terminal pattern. Once the pattern completes, the market reverses to its origin or to its starting point. So the S&P started to rally at 2,200 on March 23rd, 2020. And now the pattern is completing, so the S&P has to get back down to 2,200. So our target on the S&P is, around 4,000, which is where we're at now. You can have an overshoot and you can get to 4,200 or 4,400. But once the pattern completes, there's really nothing more we can do but sit here and forecast a decline to 2,200. And so the reason why we're hosting this event today is because we think the pattern is very close to completion, and the market is very close to a very large drop of about 50% or 45%. And that's it. I'd like to open it up now for questions. Leave it on slide 19. Slide 19.
So, Isaac, you have a question from David Nordell. Was Brickell price theory able to predict the peaks of the recent GameStop?
So we used Brickell Analytics. We zeroed in on GameStop in September of last year when the stock was trading in at $10. And we saw a pattern where we thought the stock would have to rally to the high of 2007, which is about $65. So we had a forecast calling for a rally to 65. Beyond 65, we didn't. So we were bullish at 10 and kind of, closed our bullish call at about $65, which was the 2007 high.
Okay.
Next question.
When do you expect the drop in the SPX back to 2,200? When do you expect the drop in SPX back to 2,200?
So the drop to 2,200 on the S&P is a function of the price first, and then the time. So it could be soon, or it could be 3 to 6 months.
Okay. How did you learn these methods? Did you read a book? How did you learn these methods? Did you read a book, take courses, or taught by a mentor?
We learned the research process by basically, I was running a family office in 2002 to 2010. Our investment process was based on fundamental analysis. We were very proactive in calling the top in 2007, 2008 based on fundamental analysis. But when the markets dropped and they were bottoming in 2010, our fundamental analysis didn't allow us to turn bullish. So I started resorting to external type of research that I had not learned in business school. And I came across technical analysis and decided that in order to become a good technical analysis or technician and be able to forecast the turns in markets, I had to establish my own research firm, because there was no credible firm out there that could help in forecasting this type of work. So we just developed it internally.
So Isaac, there's a question on gold miners. I don't know if you're prepared to talk about gold miners today or not, but if you're not able to talk about that, then you can answer this person offline.
No, we can talk about the gold miners. We didn't come with any gold slides today, but we can talk about gold miners. The inflation trade is a very difficult trade because the dollar is relatively very weak. So the dollar should be bottoming, which means it should be strengthening very soon. And a rally in the dollar could be very negative for gold miners and gold stocks. That said, if you zero in on patterns of gold miners and gold companies, you could have a rally in gold before the dollar begins to strengthen. So I would be long. I would be long gold and gold miners, but carefully, because I would give priority to the S&P and the deflationary wave. And in any wave where you have deflation, it's very negative for precious metals. So I would be bullish gold and gold miners, but I would be careful right now. I'm not getting a very, a very loud signal to be bullish this sector right now.
So Isaac, following up on gold, what many people call digital gold today, do you have any forecasts on Bitcoin?
The forecast on Bitcoin is very aligned to the forecast on the S&P. So I like to, again, look at this chart on slide 22. This is the most important forecast of all. When the S&P tops and declines, all assets decline. So if we have a deflationary wave, it will be very negative for Bitcoin. So if Bitcoin is at 55,000 or 60,000 and you get caught in a 50% decline in the S&P or 45% decline in the S&P, Bitcoin will probably go back down to 10,000 or 8,000. If the S&P continues to rally and press above the 4,000 technical level and try to get up to that 4,400 level that we're talking about there, then Bitcoin can do whatever it wants. It will continue to rally. So I guess it's a game of musical chairs. You can stay there. You can keep playing the game until the equity markets are ready to roll over.
Isaac, there's a gentleman asking if you have a subscription or how do they utilize your services, and do you look at any stuff that's related to real estate, for instance, like interest rates?
So that's two-part question. So yes, we have a subscription service and we can send you the link to subscribe to the service. It's either a monthly subscription price or an annual subscription price. And we'll do that after the call is over. We'll email you directly. Regarding real estate or private equity, again, our service is on the public markets, but we are of the belief that the public markets and the private markets are intertwined. You don't have two different markets. You have one market, whether public or private. So if the S&P is going to go down 40, 50%, then it's going to be very negative for the real estate market. And if the S&P goes down 40, 50%, and you have a rise in interest rates, then that's going to be a double negative for markets. So that's the other variable we have to watch here is interest rates are very low. And we haven't had a market decline in the last 20 years where interest rates are hovering around 100 on the 10-year yield, around 100 to 200 basis points. So what happens if, you know, the rates or the yields and the equity markets don't trade in on a correlation again, or they become inversely correlated? So basically stock prices go down and interest rates go up, which wasn't the case in the 2000 to 2002 decline, and it wasn't the case in the 2007 to 2009 decline. Those two declines, interest rates went down, markets went down. But here you could have a situation where interest rates go up and equity markets go down. So that would be double negative for all asset classes in the end, even precious metals. The only asset class that will gain is cash or the dollar.
So Isaac, this gentleman is asking, so Barclay is asking, you know, aside from your bearish S&P 500 call, what are some of your second strongest wave predictions? Give the group some thoughts, and if you can direct me to some slides, you know, that you would like to visit, I'm happy to illustrate some of the other calls. But this gentleman wants to hear something outside of your bearish calls on the S&P.
Well, I mean, let's be clear. The 95% of this presentation was bullish. We had a bullish call on the S&P. We had a bullish call on the Russell. We had a bullish call on JP Morgan, on the energy sector, on Boeing, on Disney, on Apple. And we're kind of running out of bullish ideas. So we were very bullish in 2020. And when you're bullish, you can be bullish on the index, or you can do stock picking. But when you start to become bearish, then you go. It's like the triangle on that slide, on that slide 22, where basically when the market is bottoming, you have a narrow range of ideas that you can pick. It's very wide, and then when the market is topping, then you run out of ideas. So right now, I don't have an answer for your question other than I'm running out of bullish ideas, and I'm, you know, kind of getting ready to call the market top in the S&P and a decline to.
So Isaac, you haven't been bearish this whole time, is that correct? Because it seems like some people are saying that you have been bearish a long time, but from knowing you and knowing your research that's come out, you know, can you just go over, and you went through the presentation, but go over last year when the market gapped down, you know, 30+%, the call that you made during that time?
Yeah, again, I mean, we can go over numerous years in our research service, but what I like to be clear is we go back to last year specifically, which was a critical year in financial markets. And we were bearish at the top in February, right before COVID. And that's slide, I think, right there, slide 12, where we were calling for a drop to 2350 on the S&P because we saw an ending diagonal pattern. Same pattern we're seeing right now. And then the S&P dropped right below 2350 and bottomed at 2190. And then when it was at around 2190, we said, look, the decline in the S&P is done. And now it has to rally to 3,500. You can change the slide now.
What do you want me to go one forward?
Just go next slide. Yeah. And then we turned bullish on the Russell. The Russell was at 1,000 and we called for 1,800. Next slide. We were bullish on the banks, especially JP Morgan. JP Morgan rallied. Next slide. Bullish on Boeing. Boeing had a huge rally last week. It's at 270, 260. Next slide. And then bullish on Disney. Bullish on the energy stocks. This was, nobody thought Occidental Petroleum at $8 a share was a buy. People thought it was going to go bankrupt. And we put a $25 price target on the stock. It got to 30. And then right at near the end of the all the economy stocks rallying, we kind of said, look, tech has to rally. And so we had to a new high. So we got a rally in Apple to the high above the September high, and it got to $150. And so we kind of looked at everything we said happened. And not only did everything that we say happen, everything went above our technical levels. So all of our technical levels got surpassed by the current rally since COVID. So we're running out of bullish ideas. And then we see a pattern forming in the S&P, which is the exact same pattern that formed between 2019 and early 2020, which is this ending diagonal pattern on the next slide.
You're talking about this slide.
Right. That's it. Yeah. So, I mean, I don't think, I don't think there's anything else we can do right now.
But just to be crystal clear, these slides that you've showed, market call 1, 2, 3, 4, these things are not, this was before it actually happened, right?
There's dates on those slides.
And you send this out to your subscribers?
Those dates on those slides are generated by Bloomberg, not by us, right? So we pick a chart from Bloomberg on any given date, and then we take the handwriting technique, which is what we use to forecast markets, and we make a forecast by hand, which is the forecast that you see right now on the S&P. So all these forecasts were made on that specific date. And again, the date is a Bloomberg date, not our date.
All right. So this gentleman's asking about wave theory, and he wants to know basically, what percentage of your predictions in say 2020 and then in 2021 are accurate versus the mistakes that you've made. Have you made any mistakes, Isaac?
Oh, of course we've made mistakes. We've made mistakes over the years that's allowed us to refine our research process, right? So that we can become bullish at market tops and bearish at market bottoms. The idea, or what I've realized with a lot of research businesses, is that they're primarily bearish, or they try to call market tops all the time. And we don't do that anymore. We have refined our research process. And so I think we climbed a very steep ladder by turning aggressively bullish at the bottom in March of last year. It was a forecast that nobody thought was possible. And so not only did we become aggressively bottom on the S&P 500 and the Russell, but we began to do some stock picking, which was not something that we were used to doing before or when we started our research process. And all of our forecasts in 2020 panned out. They were accurate. What we said happened, with the one caveat that the markets went above our targets. They're above everything we said it had to go to right now. So again, we're taking our research process from our 11 years of experience. We became very bullish at the bottom. Everything that we said happened. Now everything is above our targets. We're running out of bullish ideas. And then we have no other option right now than to zero in and add a chart, use our forecasting based on experience, look at a pattern that's forming, and just put out a bearish forecast on the S&P. It's all based on our 11 years of experience. So, I mean, do I want to call for a 50% decline? Do I want markets to go down 50%? No, nobody wants that. That's very bad. and it's very bad for the financial system. And in fact, in fact, if we are right and the market goes down 50%, we want to be able to forecast a pattern that ends up being bullish, where the bottom of the S&P is 2,200 and not beyond that. But we will talk about it when we get to that point. The bottom line here is that the forecast is just a bearish forecast. I have nothing to do than to just look at a chart and put out a bearish forecast. And to a certain extent, it's very technical and it's very quantitative. There's no emotions. There's no fundamental analysis. I'm not talking my book. I haven't bought any, crash puts yet, but I will buy them at some point. But, I'm completely neutral at this stage. And I'm just waiting for the pattern to materialize to be able to call for to prepare for the decline and then try to trade it. I mean, the other thing that's important is that this ending diagonal pattern that is materializing right now was the same pattern that happened in the summer of 2015. And it's the same pattern that happened between late 2019 and early 2020. We've had in our research service, we've had experience with two ending diagonal patterns, one in the summer of 2015 and the second one between late 2019 and 2020. And what we've discovered is they're remarkably accurate because the market goes exactly where it started. So in 2015, we were calling when the S&P was at 2150, 2130, didn't quite get to 2150. So when the S&P was at 2130 in 2015, we called for a drop to 1750, but the pattern had started at 1820 in October of 2014. So we ended up getting a reversal in markets in the summer of 2015, and the first decline or the crash in 2015 brought the S&P down to 1867. But then the subsequent two declines in late 2015 and early 2016 brought the S&P to 1810. And then the S&P double bottom and then it took off after 2016. So our reversal pattern, where we saw the pattern had started at 1820 in October of 2014, ended up materializing. So the S&P went exactly to the level we thought it would get to. And then 5 years later, in 2020 and 2020, when the S&P was at 3,400, we saw the same diagonal pattern we had seen in 2015. And the point of origination of last year's diagonal pattern was the low that the S&P hit on Christmas in 2018, which was 2350. So that's why we had a 2350 target on the S&P, last year. So the S&P ended up going down to 2196. It went, 150 points below our target, but our target materialized. So we have these diagonal patterns that we see, and then we just have to call them to their origination standpoint. That's the similarities. The only difference that I like to point out is a difference that pertains to timing. So in 2015, the top in the S&P was in May, but the crash didn't happen until August. So it was about 3 months later. That pattern, that moment in time, the S&P topped and it took its time to top before it declined to the point of origination. Last year's decline was instantaneous, it was immediate. Once the pattern completed, the S&P went down, right off the bat. So in a perfect world, the market takes its time to top because it will just give us the option. It will give us more credibility that the pattern is forming and gives us the time to prepare for it. It would be ideal if the S&P gets to 4,000, 4,200, 4,400, and then just stays there for 4 or 5 months, forming in technical terms what's called a rounded top pattern. And then it goes down in August, September of next year. But the opposite scenario could be what happened in 2020, where the market just stopped and went down right away. And then you don't even have time. So again, we would prefer a top where the market takes as much time as possible to top. The longer it takes, the better. So, but the pattern is there, and there's not much we can do other than forecast it.
So Isaac, there's some people, like multiple people with multiple comments asking, about things like, your profile and your length of experience with wave theory and Are you just selling research, or have you ever managed money yourself? And I want to like just take a moment and vouch for you. I've known Isaac for over 10 years. I've been following his research now since, we first met. And Isaac eats his own cooking, right? He does trade, and he does manage his own money. And he has been involved in the asset management industry for a long time. But Isaac, why don't you take a moment and just address some of these things using your background and your experience again to quiet some of the haters out here.
I mean, I don't know if there's haters. I mean, all the information is there. It's everything I've done is pretty, I guess, public on my website and public on my presentation. But maybe I went over it too quickly, so I can go over it a little bit slower. But I started my career in 2000 as in private client services at Lehman Brothers in New York. And I was a broker or an advisor, an asset manager. I came down to Miami and I started a family office in 2002, 2003. And I managed money from 2003 to 2008, 2007 as investing in hedge funds as a fund of funds manager. But in 2007, 2008, I realized that the fund of funds portfolio that we had was very bullish and it was going to suffer significant losses during the market decline in 2007, 2009. So I anticipated that decline and I switched the fund of funds to a more bearish kind of short biased fund of funds so that we could participate from the gains in the market decline in 2007, 2009. We were right in 2000 because we timed the financial crisis correct, but then our business, our fund of funds wasn't equipped to go long because our portfolio managers were short biased. So at that point in time, I said, it's time to call for a rally, but I didn't have the infrastructure to call for a rally because I was a fund of funds manager. So the hedge funds that I was a client of decided that I should go into the research business and start making market calls. So they started becoming subscribers to a research service that I was forced to put together for the hedge funds that I was invested in. And as I was getting paid by hedge funds that I was invested in, it became a conflict of interest to run family money and run a family office and make market calls. And then making market calls was my own business. And there's nothing, as rewarding and as satisfying as running your own business. So I decided that it was time for me to start my own business, sell research to hedge fund managers, and not be in the fund of funds business. So I shifted my focus from running family money when I was on the buy side to sell side and started producing research, and it's turned into a business. And I've done it for 10 years, and I've had hedge funds subscribe to my research service for 10 years. And I've been able to stay in business for 10 years doing what I just put together in this presentation. So my experience using Elliott wave, technical analysis, making forecasts, is something that I've been doing since February of 2011. And again, it wasn't my idea. It was the idea of hedge funds that I was invested in that said that this is what I should do for a living.
So Isaac, over the last 10 years, have you gone back and forth between fundamentals and technicals, or how would you describe your particular process?
Absolutely not. Absolutely not. In fact, fundamentals was the reason why I got into this business. We were short in 2009 vis-a-vis our hedge funds that were all bearish and had all made money, and none of them wanted to turn bullish at the lows in 2009. And because the fundamentals on the U.S. economy were very bad, the U.S. banks were going to go, they were going to go bankrupt, and everything was negative. So I resorted to an external source of information that is more neutral, more unbiased. It doesn't really, force you to pick one side or the other, which was technical analysis. And then since 2011, I've stopped doing all fundamental analysis. I don't look at any, discounted cash flows, financial statements. And granted, that's my experience. I have an undergraduate degree in finance. I have a graduate degree in finance. I worked in Wall Street. And my schooling is all about fundamental analysis. That's all I did. But now, since I started the research service, I haven't looked at anything fundamental. I just do only technical analysis.
All right, great. So this gentleman wants to know about expression of your, how do you express yourself and your technical views using wave theory? How do you actually take those views and create a trade to hedge or to protect yourself? What is it that you do?
So you can buy stock at market bottoms, as we illustrated on the charts, prior charts. You buy the stock at the price levels where we're saying Occidental Petroleum was a buy at 8. And I think, a lot of people here in Miami that know me, we have a group of people that, we have a little finance club. Everybody knows we were bullish Occidental at 8, and you just buy it, right? It's a little trickier when the market is getting closer to topping, because at that point you gotta, pretty much sell your stock and slowly go to cash if the market takes a while to top. If it doesn't take a while and it goes down quickly, then you're gonna get caught in a big market decline. But when you're at a market top, you gotta trim your equity exposure down. If you want to be aggressive, then you short the market, and the best way to short the market is in the options market, so you don't have unlimited downside exposure, where you can, if the market continues to go up and up and up, then you lose money, which is what happened in GameStop. People who were short GameStop at $30, were suffering significant losses when the stock was at 250. In this case, what I think is the best way to express a view when the market is very high is you just buy options, and then you cap your losses if the trade doesn't go your way.
All right. So Isaac, there's obviously a lot of people who are asking, if the market does drop 40 to 50%, like your prediction suggests, what sectors, asset classes do you think people should invest to be long and make money, right? So if you have to have exposure, where should you be in the event that this thing does fall to 2,200 on the S&P 500?
Where should they be now, or at the low?
No, like traditionally, if you saw a market correction coming, you put your money into treasuries. And
the problem with putting money into treasuries now, and again, we didn't address that in this presentation, we can do that at another point, is where are interest rates going to go? Because you could have a phenomenon that you've never had before, which is markets drop and interest rates go up. So if you say, okay, the S&P is going to go down, I'm going to buy treasuries at 150 basis points, and then yields go to 6% while the market drops, then your treasury portfolio is going to be in trouble too. So I think the best place to go is cash. You just raise your cash reserves.
So does that tap into rising yield deflation?
Probably, yes.
All right. I mean, this isn't up for that, but that's a very interesting concept that you introduced to me a number of years back. Is there any information on your website about rising yield deflation?
Yeah, everything's on there.
So if they want to learn more about your views on rising yield deflation, which is almost like an oxymoron, really, they can go to your website and check it out?
Yes.
All right, perfect. So people want to know about crypto. Can you apply these tools that you have, the Brickell time model and the Brickell velocity indicator and wave theory and price theory? Can you apply that to Bitcoin, for instance? And do you look at this? Because there's a lot of people asking questions about cryptos.
Yeah, so Bitcoin has a wave, and it's very analyzable. We can look at the Bitcoin wave and see how it's, you know, rising very rapidly and getting close to a top. But as I said earlier, we already addressed this. Rather than sit here and call the top on Bitcoin, and then Bitcoin goes from 55,000 to 65,000 and we're off by 20%, I would rather spend my time and my energy on forecasting the top in the S&P. Because I know, I'm certain about this, that if the S&P tops and goes down by 50%, crypto is going to go down by 90 or 80%. So rather than sit here and call the top in crypto, right, I'll let crypto do whatever it needs to do in terms of topping. And then I want to zero in on the S&P 500 and make sure I can get it right. Because if the S&P tops at 4,000, crypto will top and then it will go down. They're very correlated. So more important than crypto is the S&P 500.
All right. So look, here's a gentleman, and when I said haters before, I didn't really mean haters. I just think that, you know, maybe some people have different views than you, and your call for a massive correction is in direct opposition to the risk that they're taking today. So they may not agree with you, and sometimes instead of attacking your analysis, they sort of attack the wrong things. But this is a gentleman that believes in fundamentals. And with regards to fundamentals, he has talked about the reopening of the economy, the stimulus, right? You know, the fact that airlines, hotels, casinos, restaurants, you know, a lot of these companies are trading at very reasonable price to earnings. And, you know, with the vaccines, you know, there's a lot of economic activity. There's a lot of cash that's going to trade hands, and you're calling for a correction in front of that. Can you address that?
Absolutely. I think that's a good question. Can you go back a few slides until we get to that Boeing slide, please?
Sure.
There. So here's a stock, Boeing, that we really, really, really liked, right? It was a $144 stock. And when Boeing was $144, we weren't really talking about reopening. We weren't really talking about flying. We weren't really talking about airlines. We were talking about lockdowns, and the fundamentals and the headlines were very, very negative for the travel stocks and the travel and leisure sector, and the airplane manufacturers such as Boeing. So this is the point that I'm trying to make, where we don't do any fundamental analysis because our process is strictly technical based. And I've learned that the easy way or the hard way back in 2010, when I had a family office and we were managing money using fundamental analysis, right? We changed that. I scrapped that analytical approach from my thinking. And all I do is technical analysis. So if you go back and study the headlines on Boeing, anywhere between March of 2020 and November, and before the elections, November of 2020, they were negative. Everything was negative. Yet we came out and we said the stock's going to rally to 250, right? So it's almost, 100% rally. We were calling for a 73% rally, right, in a stock that everybody hated, right? That was a significant rally. It's a significant market call. And as you can see from the chart, it's a chart from November 1st. And you know what happened? Boeing rallied to 270. And now that Boeing is at 270, now we're talking about reopening and vaccines and old economy shares and airlines and flying. Now, when we thought what we thought was going to happen in terms of price in Boeing and in the airlines has already happened, is people are already talking about it. So I cannot do anything with the headlines or the fundamental information on these travel stocks because it has already materialized in terms of price, because we're a price-based analysis. We just look at a price and we make a forecast. It's either low or high. And so I don't have much to say in terms of reopening stimulus airlines, other than I think that trade is either maxed out or it's close to getting maxed out and getting very crowded. And it should reverse in the opposite direction if the S&P, again, if, and as long as the S&P, tops between 4,000 and 4,400 and goes down. I think, if the S&P goes down, all the travel stocks are going to go down. And, we're no longer bullish that sector anymore, because what we said that needed to happen already happened, plus a little more. We had a 250 target on Boeing, and Boeing got to 278. I can't be bullish, Boeing right now. And if I'm not bullish Boeing, I'm not going to be bullish American Airlines or United or Wynn or Las Vegas Sands or anything that's tied to travel and leisure, because I think Boeing is the core company, or it's the most important company in that sector.
So Isaac, again, to that point, and I hate to keep going over this, but you're a purist, so you're not looking for the fundamentals why, but this gentleman's asking, what's the catalyst that leads to a 50% drop? Won't the Fed step in and prevent such an event?
So I like the slide that you landed on. What is a theory, even though I wasn't planning on getting on there. So wave theory, wave and price theory, and we can go over theory right now. It's basically a method of technical analysis to identify impulse waves, modus waves, corrective waves derived from investor psychology, offering deeper insights into trends and dynamics. And price theory is developed through modeling techniques, whether it's mathematical or handwriting, and you monitor trends and you count waves using a system of 73 rules. So this technique that we use, or this process that we use to forecast, doesn't incorporate such things as catalysts or fundamentals or other types of analytical tools that people use to look at markets. It's not in that slide 5, and if it's not there, then we don't really use it. So what the catalyst is, I have no idea what the catalyst is. And what the Fed is going to do or not do, I have no idea. I think catalysts and the action of the Fed is a lagging piece of information. They lag the price action. What really, directs markets is the price, right? It's the waves and then the price. If the price is very high, things go down. If the price is very low, things go up. It's as simple as that. I try not to overcomplicate the analysis.
All right. So Isaac, a good friend of mine, Gudrun. Hi, Gudrun. I hope all is well for you. She's asking about the VIX and why is the VIX so low, and do you see a reverse on it, in the cards on coming?
So I think all questions are excellent. There's no such thing as a bad question. All questions are good questions, but this is one of my favorite questions that I just got asked. And, I could have added a slide and a VIX, or maybe I should have, and then I'll do it next time. But can we go to slide 20, please? Or 22, that slide on the S&P. 22, yeah. So I love the VIX question, because the S&P in technical terms is forming what's called a rising ending diagonal. It's rising and it's bearish. On the opposite end of the spectrum is the chart on the VIX. The VIX is forming what's called a bullish declining ending diagonal. So the chart on the VIX looks very bullish, and the chart on the S&P looks very bearish. It's at the opposite end. So we have a bottom target on the VIX between 20 and 15. And once the VIX bottoms and breaks out of the triangle in the opposite direction of the S&P, it should go to about 100. So I'd be happy, to email that slide or send this person the slide on the VIX, which is just the opposite slide, the opposite of our S&P slide. And for future presentations, we're going to make sure we have a VIX chart on there, because it's very important. And so thank you for that question.
So Isaac, just quickly, do you think the VIX is going up above 80 again?
100.
It's going over 100, or is that the target?
The target is 100. We bottom at around, again, if the S&P tops at 4,000 or 4,400, anywhere in that range, and also depending on how long it takes for the S&P to top there, because the VIX is also a function of the volatility of the market. So if there's no volatility for 2, 3, 4 months, you're going to get the VIX to go down more than if the market tops quickly and then drops. So let's say, you know, the positive outcome or the good situation would be for the market to take its time to top. So if the market takes its time to top and we see the VIX drop to about, it could drop to about 15, 16, 17. And then it should get above the high in 2020, which was 85, 89. So we have a 100 price target on it.
Okay. So Isaac, this gentleman's following up on your statement that you've run out of bullish ideas. Does that just mean there aren't any indicators that would suggest the bull market would continue?
So I like that question. Actually, it's a really good question, because that's what we're doing right now, rather than, you know, and then part of the reason we haven't discussed all these bullish indicators, we are looking at the S&P, but we are monitoring other markets. And that will give us more information on how closer the S&P is to topping. But part of the reason why we didn't do that today is we don't want to give away our information for free, because we have paying subscribers to our service. So we have some more bullish ideas that, you know, haven't really materialized completely. And when those materialize completely, then we're going to be closer to a top. But and I'm not going to share all of them or any of them on here, but I will share one of them, and it's Facebook. I think it's critical for Facebook to get to 305 or above. Facebook has not gotten above the high it reached in August of last year. The high in last year was about 305. So if we see Facebook at around 305, 310, then, you know, that's another confirmation that the market is closer to topping out. So that's a bullish idea that we have right now, where we think Facebook has to rally to 305, 310. Last time I checked, it was at 280. So you have another 25 points there in the stock before it gets ready to top out. So that's an important indicator to tell you whether the S&P is closer to topping out or not. And of course, if we're bullish on Facebook, that means the S&P shouldn't decline until Facebook, you know, goes up. And if Facebook starts to go down right now, then of course, you know, we're getting something wrong in our timing analysis. So, you know, in terms of bullish ideas running out, yes, we're running out, but we like to think Facebook is going to rally to about 305 or 310 before the market drops.
So I just wanted to quickly say, I believe, Barclay, that touches on your question that you put in. And Don, I believe that touches on your question again. So I think he answered like 3 or 4 different people's questions, you know, with this last round, and also Aaron, you know, so Nicholas, he said that he has bullish ideas, but he wants to be paid for them. You know, Gudrun has a question regarding artificial intelligence and machine learning to predict what stocks / indexes go up or down. Some have good track records. How does what you're doing compare to some of these artificial intelligence neural networks / machine learning, you know, compared to what you're doing? And how do asset managers use you inside of their portfolio management process?
So that's 2 different questions. One is, how do asset managers use you? And then the second question is artificial intelligence and machine learning. Can we go to slide 6, 7, please, if you don't mind?
Sure.
there. No, that 9, slide 9, and then slide 10. So that's a machine. Slide 10, please.
I'm sorry, Isaac, this way?
Yeah, so that's a machine we built on the S&P 500. It's a very simple, it's a complex machine in terms of programming, but it's a very simple machine in terms of the information it gives you. And it's very easy to trade. It's just a signal that the machine generates on the S&P 500 every day after the close. And it tells you either you should be long or short the S&P going into the next day. The signal doesn't really flip-flop that much. So you could get a long signal for 30 days, 60 trading days, 90 trading days, and it just depends on the trend. So we have removed emotion and any type of human component to our research through this type of systemic approach to markets. And what we do is we call for the direction of the S&P 500 based on the model, and the model has performed. And so that's our expression of machine learning or artificial intelligence, and it's all programmed. We don't we have no human element involved in it other than sending you guys, our subscribers, this signal. Did that answer the artificial intelligence question?
Yes, it did, Isaac. It did. So we're almost out of time. I want to be respectful to your time and to the audience's time today. But if you could just wrap up with, how do money managers use you? How can they rely on you to help aid their portfolio management?
So money managers have to execute trades or put on trades, and we give you ideas with a timing component, or with a timing and a directional component. And I think our targets over the years have gotten better. So if we're bullish on something, it's usually pans out over time. And we may be wrong by 5%, 3%, maybe sometimes we're wrong by 10%. But markets, when they're low, they go high, and when they're high, they go low. And so we serve as a tool or as a timing indicator for portfolio managers on how to position themselves accordingly, when they should be more bullish and when they should be more bearish or more cautious.
Got you. All right. So Isaac, thank you very much for coming on today and sharing your views. I'm sorry that we didn't get through even half of the questions that were asked. There was a lot of them, but we will follow up with an email. This concludes today's session. Isaac, I want to thank you. I want to thank Brickell Analytics for sponsoring the session today. And thank you to the audience as well. Appreciate all of your time and attention. If you have any questions, feel free to email me. Have a great day. Take care.
Thank you. Thanks.